So what are the biggest roadblocks that you guys see on a day-to-day basis?
For me, it's mind share and education, or mindset and education. Mindset that Bitcoin is a store of value and a digital gold only, or as some governments and institutions are realizing and referring to it as a sleepy asset, that it actually can have productivity. It can earn a yield. It's productive. And then I think the other is education, is that continuing to educate that Bitcoin is something that you can buy, you can hold, you can store, you can earn off of, but also you can build off of as well. And that's a big educational effort, whether it's from the Lightning side to Rootstock, Stacks, Core, Babylon, BitLayer, doesn't matter the protocol. That's something we all have to work towards continuously to educate on what these things are.
Mm-hmm. Yeah, I mean, it's educational for us as well. And, you know, depending on who you're talking to, we have a dual-sided marketplace, right? So obviously protocols are very, very interested in Bitcoin liquidity. Obviously, people are very, very interested in a reward rate attached to a Bitcoin staking position. The good thing for us is, you know, proof of stake has been taught to the broader industry for 5 years, right? So really, it's just reworking that for Bitcoin. It's like, well, I was told I wasn't supposed to do anything with this forever, and now, you know, you're telling me that I can do something. And then, depending on what protocol you're talking to, I think a lot of people are seeing it as a differentiator if they're like going to market, right? It's like, oh, we really want to work with y'all, and we want to be this thing that's different, that becomes a Bitcoin-centric economy, that is a proof-of-stake ecosystem that has its own use cases beyond that. But we see this as the pristine store of value asset and collateral asset for DeFi. And if we don't have that, then we're not going to get to the next cycle of being, you know, something that's legitimate long-term. So regardless of like how you're looking at a protocol growing, right? You have this like, you know, asymmetric speculation on this being like crazy, and maybe there's a bunch of meme coins on that, but eventually like a large sustainable layer 1 protocol wants to diversify away from that, at least for like at some capacity, and then that results in like bringing RWAs, stablecoins, and Bitcoin into the ecosystem. And I think, you know, everyone that's building these solutions around injecting that liquidity into those ecosystems are providing value to those.
For me, it's education as well, but with a different slant. So if you think about our focus is really bridging Bitcoin to traditional finance. Why? Because even though Bitcoin was created to be an alternative to the existing financial system, you can't really parachute into the future 50 years from now when that might well be true. So in the interim, you need that bridge to make sure that Bitcoin is something that's easy, simple to use. And if you think about 10 years ago, most of the people that were involved in the Bitcoin and crypto space were mostly technologists, right? Now, as we see the bridge to, thanks to traditional finance, Rails, and what have you, you know, and the simplicity of the platforms, you can make it a much sort of broader and appealing product for everybody. So that means that for us, we have no choice but to engage with traditional finance. And the amount of time that I spend educating people in the traditional finance space is significant. There's a lot of heavy lift there still to be done. The price of Bitcoin certainly helps, right? The interest is there, and almost every traditional finance company will have a team or people working at looking at the space. You know, I saw S&P were here earlier. I had a chat to some of them. There's no way you're going to see S&P at a crypto conference 5 years ago, right? So that shows that there's progress. But I do think that there's still a lot of marketing on that traditional finance side and from some jurisdictions and regulators versus actual execution and traction. You know, if I think about Singapore, Hong Kong, yes, they spoke about, well, we're a bit more crypto friendly. It was Switzerland back in the day. My experience, because I've worked with all those jurisdictions, is the government side would be very pro working with Bitcoin, and then when you got to the regulator, it was computer says no. And I think it's the same with traditional finance. You know, oh yeah, we want to be involved and understand crypto, we want to use the use cases. Okay, well, we can work with you. We've got a banking license, we are members of Visa and MasterCard, all the things you would expect a bank to have, we have. But yet somehow the moment you mentioned the word Bitcoin, it's very much still a very heavy lift to get in the door.
So just going back to you, Seamus, just so with the tariff uncertainty we're seeing, geopolitical uncertainty everywhere, and coming from the UK, we're seeing the most amount of millionaires leaving. Have you seen a pickup in demand for your services? Or what other events specifically where have you seen an influx of people coming in and using it?
Well, I think price action in Bitcoin is very relevant for us for a number of reasons. We built Xapo almost with the same tenets of Bitcoin itself, which is how do we make it as decentralized as possible so that it can't be interfered with by jurisdictions and governments or whatever, and how can we serve as many people as possible. So we kind of emulated the Swiss banking model, and we did it in Gibraltar because we found Switzerland not to be that Bitcoin friendly.
Yeah.
So they developed their DLT regime, so we did the sort of VASP regime license next to the bank in Gibraltar for that reason, and essentially it's an offshore bank account that you're opening up, even if you might be in Japan, Brazil, or whatever. So where you reside is irrelevant. As far as we're concerned, our customers are Bitcoiners, and their geography is kind of irrelevant. That's how we try to operate. But what we do see is, as the price of Bitcoin goes up, people ask themselves that tough question, which is, self-custody is well and good, but at what price is the risk too high, right? So we spend, on average, somewhere between $15 and $20 million a year on securing and custodying our customers' coins. Back in 2017-18, we were the largest custodian of Bitcoin on the planet. We had about 1 million coins in our bunkers before we sold the institutional business to Coinbase. So we know a thing or two about keeping coins safe. And that's really our trusted brand, And we see that people, as the price goes up, they start leaving us a few Bitcoin, and as they love the product, they trust the brand, they understand what we do to keep them safe, we see an influx of more Bitcoin coming in because they realize that self-custody is well and good until you make a mistake, and you're putting your life savings at risk. When those life savings were $10,000 in 2015, it didn't matter. Through price appreciation, it's now a lot of money, and people are making that leap into saying, okay, I trust you guys with my coins because I don't trust myself as much as I trust what you can provide in terms of your infrastructure and your know-how.
So we're in 2025, let's say we get to the next halving in 2028, what does that look like for each of you? Not price prediction, just what that looks like for you.
So it's in 2028, so about 3 years from now. I think we have an exciting future ahead of us. I mean, right now, as I noted, we got about, we'll call it 1.5% of Bitcoin capital today, currently productive in a number of different protocols and assets. I think as we start to look towards the next couple years ahead, we can definitely see us tip over 5% and hopefully even more. Get us to 10% of that $2 trillion that is being productive in DeFi protocols and also tokenized assets. That's something, again, we're very heavily focusing on at Stacks, but I'm watching across the entire space right now evolve. I think that we'll also see a very big opening around policy as well, that countries will continue to open up and embrace. You'll see many more sovereign wealth funds take Bitcoin onto their balance sheet, core Bitcoin, not just IBIT or other spot ETFs. And then also you'll start to see a rise of the Bitcoin standard companies at mass. Right now there's 80. I expect to see by that time triple digits, if not 4. Yeah. Thousands of companies taking that on as a potential asset class.
Yeah, in the UK, we have the FCA, the Financial Conduct Authority, and UK are actually banned from owning any form of ETFs. So the only real exposure at the beginning was owning MicroStrategy in August 2020. So for me, that was the avenue. So we bought, so anyone that would have had NASDAQ exposure, tech exposure, it all went into MicroStrategy, which obviously contributed to the premium. But the FCA being so harsh against Bitcoin and no access to ETFs allows investors to own essentially a derivative of Bitcoin that levers up on debt and does ATM debt dilution. So I'd say ignorance really makes it a really bad situation.
Yeah, and I think one other bold prediction on top of that of what the UK has done is I think we'll also get to a point, if not in the next year, hopefully in the next 2, where everyday retail users can have Bitcoin sitting in a wallet click once, and all of a sudden start earning passive income.
Yeah.
We've seen a lot of that in the Stacks ecosystem with our asset SBTC and the ability to earn a passive income off your Bitcoin with one click. I think we're going to see that in waves that you're going to be able to even get into a diversified portfolio. So say you have one BTC, you click auto, and all of a sudden it's divided in 4 different strategies automatically for you. We're seeing the beginning of those rising funds right now, where some of your Bitcoin will go into staking, some of it will go into core yields, some of it will go into other areas, and we'll continue to see that rise.
I think when looking, maybe not the 2028 halving, but the one after that as well. I mean, there's 3 ways that you can make security sustainable. You can inflate the token more, you can increase fees, or you can create more demand for the reward asset for the miners or the validators. One's definitely not going to happen for Bitcoin. It completely destroys the value proposition of 21 million Bitcoin. 2, it's dependent on the ability to have more expressivity natively on the Bitcoin network. So what can you start doing now is you increase demand for Bitcoin. And that's providing more use cases for it beyond store of value and send and receive. But if you're not actively doing 2 or 3 right now, then you do get into kind of a worrisome situation, maybe more into 2032 or beyond, because you're not going to be able to pay for the security that you demand so much as a Bitcoin holder.
I think the next 3 years are going to be fascinating. We're seeing this pick up in adoption. I think most companies out there, they're not asking themselves why they shouldn't have at least a 2% allocation of their capital into Bitcoin. They probably should. The downside, if it's a small allocation, the downside risk is fairly low. The upside risk is huge. The potential is huge. So most institutions out there are and should be asking themselves the question, am I willing to put a couple of percent allocated to Bitcoin? But then against that, you've got regulatory uncertainty. So right now in the US, we're in a very positive regulatory cycle. In the UK, you mentioned it yourself, it's quite negative. Europe is going in a similar direction with MiCA and whatever else. So that could very easily shift. And in the industry itself, I think you're seeing some consolidation. The players that have been around for a while, the big guys, Tether, for example, it's pretty clear that they're dominating the stablecoin front. I mean, there isn't room for 50 stablecoins. You can only have a few. So I think you're going to see consolidation. But within that underlying theme, a lot of what I'm hearing, particularly I was recently at Token 2049, is there's a lot of interest in derivatives. Everybody's looking at derivatives. Everybody's looking at how to create that leverage exposure. And there is a room for derivatives in financial services, but when you have already an industry that's a little bit, still in its infancy, maturing, and therefore the prices are volatile, and you throw derivatives at it, I see a world where there's huge risk in the next couple of years. We have another FTX. Somebody's balance sheet will blow up, right? And that is going to cause the next crypto winter. So I see that there's huge amounts of positive upside in terms of directional travel. Regulators are still nervous. If somebody's balance sheet blows up, things are going to get harder before they get better. And then the next Bitcoin wave, which will happen after the next halving, and we start off on another cycle, will probably be the biggest Bitcoin wave of them all. But I think we're going to see some pain before we see that.
Well, one thing we haven't mentioned is what was announced last week in the United States is the openness for banks to begin offering custodial services around crypto assets, and Bitcoin was mentioned in that. And then you had 2 major holding companies that came out, one this week, one about 2 weeks ago, 21, that opened and showed the amount of demand looking at Bitcoin as something they want to hold and earn off of. And so I think you also have in that prediction into the next halving is if this banking infrastructure change takes place and we see this demand continue to only increase as we're seeing on a week by week, almost day by day basis globally, we could be in a completely different world if every single financial institution is able to custody Bitcoin, Ethereum, and stable coins. And then that may open up alternative assets as well. That changes the game on everything that we're talking about right now.
I mean, don't get me wrong, you're spot on. That's the bull case.
Yes.
In that bull case, if you add banks opening up to custodians, more derivatives, and still learning risk management practices. I do see risk that I think it'd be naive for those of us who've been in Bitcoin for a while to not think of the cycles. After every boom, there's a bit of a bust. We should be asking ourselves, what will cause the next crypto winter? And if we can mitigate that risk, then it won't happen. But if we pretend that the risk isn't there, chances are it might come about, and that is one of the risks that I see. So I'm hugely excited, just as much as you are, but I think there's an element of caution that there might be some pain to be taken before the next bull run.
Thank you very much.
Thank you.
Thank you.